All right. Hello, everyone. My name's Naomi Hogan, joining from the Australasian Centre for Corporate Responsibility. It's my great pleasure to be hosting this webinar today on our steel decarbonisation work. A bit of housekeeping firstly. This webinar is being recorded and we'll be sending out a version to everyone that has RSVP'd after this session. I'd also like to start by acknowledging country. So I'm joining from Awabakal country here in Australia. And I'd like to acknowledge their elders, past and present. And I'd also like to acknowledge the First Nations leadership that we see globally that will be so important for the energy transition we have, and acknowledge the work that they're doing to strive for co-ownership of renewable energy and acknowledgement of the land on which the future mining and renewable energy projects will be built. I'm going to jump straight into our next slide to introduce our agenda and our incredible speakers here. So this presentation will hear from Fiona Deutsch from ACCR. She's our lead researcher in steel, and we'll be talking through our insights for the Green Steel Transformation report. Then we're going to jump to Dr. Jorrit Jossens from the ANU, who will be speaking through his research, and we're so pleased to have you. Thank you. And then we'll hear from Jasmine Fowler-Morrow from ACCR to talk through a really interesting investor sentiment mapping that we've done on steel decarbonisation. And we'll have time for some Q&A at the end. So I'm going to jump right in and share over to Fiona. Thanks, Fiona.
Thank you, Naomi. Hi, everyone. My name is Fiona Deutsch. I'm also the lead analyst and company strategist at ACCR. Now, there are 4 key messages that I'd like you to walk away with today. Firstly, there is palpable momentum towards global steel decarbonisation. Half the initiatives by leading steelmakers are set to significantly cut emissions. That being said, 40% of projects are still focusing on solutions with limited potential to reduce emissions, so there is still much work to be done. The issue isn't with steel itself, but with its production process. Eliminating metallurgical coal from iron making is essential for steel sector decarbonisation. And lastly, for the iron ore miners, there is a significant opportunity to innovate and reduce Scope 3 emissions, which are predominantly emissions from steelmaking, through process and technology improvements. So let's first ensure that we're all on the same page. Steelmaking accounts for 11% of global CO2 emissions, making it a major contributor to climate change. We have yet to see peak emissions from this sector, indicating that the highest levels of pollution could still be ahead. Therefore, a rapid pace of decarbonisation is crucial. Meeting net zero commitments and aligning to the Paris Agreement demands urgent action. So let's break down this process simply. Steel production has 2 main steps. In part A, iron is made here. And in part B, that iron is turned into crude steel. In part A, iron making, this is where 90% of the emissions in steel making stems. So in primary steel making, metallurgical coal is heated in a coking oven to transform it into coking coal. Coking coal is then combined with iron ore in a blast furnace to produce iron. The iron is subsequently placed into a basic oxygen furnace to produce crude steel. Alternatively, in the realm of recycling, scrap steel is placed into an electric arc furnace or an EAF to produce secondary crude steel. The other thing to note here is that primary steelmaking generates about 2.3 tonnes of carbon dioxide per tonne of steel, primarily due to the use of coking coal in this process. And this figure really highlights how iron making, as you can see here, is responsible for 90% of the emissions in the steel value chain. So what does that mean? Steel does not have a climate problem. More accurately, iron has a coal problem. So what steps can we take to address this coal problem? And this brings us to a critical juncture for the steel industry. Looking towards 2030, an eye-opening 71% of global steelmaking assets are approaching the end of their operational lives. This presents a unique yet urgent opportunity for change. Choosing to reline these aging blast furnaces could lock us into another 2 decades of heavy coal use. Such a decision risks creating stranded assets, particularly as the world pivots to decarbonisation. The choices made by companies, investors, and policymakers in the next 6 years will dictate our emissions trajectory, leading us either towards significant reductions or maintaining the status quo. Recent findings from the IEA and the Australian government mark a clear path. By 2050, we're looking at a substantial global downturn in metallurgical coal production and trade. According to the IEA, no matter the scenario, be it STEPS, APS, or the NZE, metallurgical coal's decline is notable and consistent. In fact, year over year, these projections have only gone down. The Australian government's latest report echoes this, expecting a peak in coal exports soon with a steady decline to follow. And this decline signals a major industry shift. With the rise of electric arc furnaces and green steel production, traditional demand for metallurgical coal, especially for blast furnaces, is under threat. Let's now explore the current landscape for steel industry decarbonisation. So instead of getting tangled in what exactly green steel means, we look to what really matters, and that's the emissions impact of the various technologies and solutions. We categorize them into green potential, so that's steel production methods like renewably powered electric arc furnaces and green hydrogen iron making, which look to eliminate fossil fuels entirely from the process. Then we had low carbon potential, so these are processes that still reduce emissions, but may use fossil fuels or emit carbon to some extent, and that includes gas-based iron making and biomass use. And finally, limited potential. So these are technology solutions that currently offer minimal decarbonisation capabilities on their own and can include blast furnace optimization, CCS, offsetting, and mass balance. Okay, so now we'll move to our analysis of the steelmakers. So our analysis of 16 key steelmakers revealed their combined absolute emissions were 0.74 gigatons, accounting for 2% of global emissions in 2022. However, not all steelmakers disclosed absolute emissions, noting gaps from two large Chinese steelmakers, Baowu and HBIS Group. The benchmark for best practice in emissions disclosures includes comprehensive reporting across all emission scopes. So that includes 1, 2, and 3. Detailed disclosure not only enhances transparency, but also enables more accurate assessments of where the industry stands in terms of climate impact. Now, our analysis of carbon intensity has found that half of the companies that disclose carbon intensity were above the global average of 1.9 tons of carbon per ton of steel. Nucor, which has a focus on secondary steelmaking and is a major buyer of renewable energy, was the only company we found that has an emissions carbon intensity below the global average for scraps EAF steelmaking. The average intensity of the companies examined in our report of all of the companies we looked at was 1.8 tons of carbon per ton of steel. And that's quite consistent with the global average. Looking now at steelmakers' climate commitments, an interesting pattern emerges. All steelmakers have outlined plans aiming for very steep emissions reductions occurring post-2030. In these figures, we've rebased targets to 2022 for consistency. The figure on the left outlines steelmakers which have absolute emissions targets, and the chart on the right is companies that have carbon intensity targets. We recommend emissions intensity targets, which are split by primary and secondary steelmaking emissions per the SBTi guidance. And this demonstrates emissions are being reduced due to genuine decarbonisation processes rather than merely reductions in production. Targets should also include overseas assets and joint ventures, and ideally be aligned and verified by rigorous and holistic frameworks such as the SBTi. This ensures decarbonisation is equitable and targets are scientifically grounded. Interestingly, no company we analysed fully satisfies best practice target setting yet. So this table speaks to the steelmakers' climate commitments in a bit more detail. There's quite a bit of information here, but to summarise, there's a lot of red in this table, and that indicates laggard commitments, particularly regarding short-term targets, targets that cover Scope 3, and SBTi alignment and verification. However, it also highlights the opportunities to robustly engage with these companies and improve this ambition. As we examine the investment landscape, globally, we're seeing a really promising shift, with half of the steel industry projects targeting green potential technologies. This indicates a strong momentum towards decarbonisation. Europe stands out for its strategic green investments, buoyed by early industrial benefits, renewable energy, carbon pricing, and subsidies. Conversely, steelmakers in the US and in Asia exhibit quite varied commitments, balancing between high impact and limited potential projects. Unfortunately, more than a third of the projects pursued technologies with limited emission reduction capabilities, including CCS. Bloomberg data indicates that some of the least effective decarbonisation options may also become the most costly in the future. And this raises critical questions for investors in these companies. Why are companies pursuing paths that are both ineffective and expensive? We see leaders demonstrating the importance of prioritizing quality, impactful projects over quantity, really setting the pace for the industry. ArcelorMittal has a broad undertaking, and that underscores the critical need for strategic focus, where quality and efficacy of decarbonisation projects should prevail. JFE and Nippon Steel have a bit of focus on projects with limited impact, and that might reflect Japan's renewable energy and steel industry challenges. This also shows how geographical bottlenecks can really temper ambition. When looking at the types of technologies being pursued, we found a preference for green iron production using green hydrogen, potentially signalling a consensus path forward for the industry. Despite this, CCS, as I've mentioned, continues to attract interest, with 21 projects exploring its viability and reducing and capturing steel emissions. Now, where CCS is planned to be in use, there's a critical need for transparency. Companies should disclose full performance data and investment cost for shareholders to realistically assess the technology's impact against its theoretical potential to reduce those emissions. While a number of leading steel producers are making substantial financial commitments to decarbonisation, there is significant variability in the specificity of reporting, allocation of funds, and timelines for investments. Our analysis delved into each steelmaker's decarbonisation projects, assessing the clarity of research, those objectives, green potential, progression, and disclosed investment, revealing a substantial transparency gap. None of the steelmakers have perfect disclosures. SSAB might be the closest, however, it really only has a handful of projects. On the other hand, Nippon Steel, for example, with 16 projects, has very little disclosures at all. Each company should detail a clear transition pathway, including technology contributions to the emissions reductions, those timelines, and a clear costed plan for the next 3 to 5 years. And those disclosures aim to clarify investment priorities for investors to help them assess how effectively shareholder funds have been spent towards decarbonisation. Now, the emergence of green steel ventures in the last few years marks a significant shift, accelerating the industry's transition towards decarbonisation. With facilities spanning from Sweden to Western Australia and expected operational start dates from 2025 onwards, these ventures are igniting a competitive race towards decarbonisation, urging traditional players to expedite their efforts to secure a competitive share in the evolving green steel market. Okay, we now move to our findings on the iron ore miners. Now, exploring the role of the 4 major iron ore miners is really important because of iron ore's critical position in steelmaking. These miners represent 41% of global production, holding significant influence. As you can see in this chart, their Scope 3 emissions, which are in blue, which largely stem from steelmaking, exceed 95% of their total emissions. And this poses significant risks, including regulatory pressures, loss of market share, reputational damage, and threats to financial stability, if not adequately addressed. Now, despite these risks, a notable gap exists in setting tangible Scope 3 emissions reduction targets, specifically for steelmaking. The lack of Scope 3 targets underscores the uncertainties about the steel industry's path to decarbonisation. So we believe to mitigate these uncertainties and to foster an ambitious transition, there's a crucial need for enhanced international collaborations, more comprehensive disclosures, and proactive policy advocacy. These steps can help demystify the decarbonisation pathway for stakeholders across both sectors, catalysing a faster and more coordinated shift towards decarbonisation. And what's been really excellent to see is that despite the lack of target setting and ambition there, they are advancing decarbonisation efforts with a collective push towards green iron and steel projects that often outpaces the initiatives by major steelmakers themselves. There is some lean towards decarbonisation solutions with limited reduction potential, particularly by BHP, which also uniquely continues to mine metallurgical coal. But the sector's overall trajectory emphasizes a significant commitment to the reduction of steel sector emissions. Looking at the technologies the iron ore miners are pursuing, we can see that they're prioritizing iron ore beneficiation, or the process to upgrade their low-grade iron ores to ensure that they're compatible with green steel pathways. Following this, the advancement of green iron options emerges as another critical strategy that they are pursuing, facilitating their transition. Again, when we look closely at the quality of the disclosures for these decarbonisation projects, like the Steelmakers, numerous projects lacked clear objectives and detailed information on investment or spend. Companies must really outline that clear transition pathway, including the technology's contribution to emissions reduction, project timelines, and a detailed costed plan for the next 3 years at minimum. And in some very welcome news, after engaging with investors and Rio Tinto on these disclosure gaps, ACCR tabled a shareholder proposal asking for these disclosures prior to Rio's 2025 AGM. And last month, Rio Tinto committed to enhance these disclosures, becoming the first iron ore miner to commit to this level of transparency in its steel decarbonisation efforts. Okay, and finally, we move now to policy. So good policy should catalyse the steel industry's decarbonisation by fostering a regulatory and financial environment that promotes renewable energy, lowers the cost of green technology, and imposes penalties on fossil fuel usage. While initiatives like the EU's Carbon Border Adjustment Mechanism, or CBAM, begin to address those needs, the presence of significant policy gaps, particularly in extending robust support to emerging economies, underscores the urgent need for comprehensive global policy reform. And in light of this, we've outlined key expectations for investors regarding companies' policy and lobbying disclosures. On the left, we've stated companies should maintain clear region-specific policy positions accessible to the public, focusing on renewable energy, carbon markets, and green technology incentives, while promoting increased circularity and technology sharing across the regions. Additionally, companies must also ensure their lobbying efforts are transparent, consistently reviewed for alignment with decarb strategies, and actively contributing towards achieving the objectives of the Paris Agreement. Investors have a crucial role to guide capital and encourage policy frameworks that are vital for a swift transition. At the end of the day, the leverage and influence of financial institutions are key contributors to accelerating the industry shifts. By advocating for policies that leverage the unique strengths of various regions, supporting renewable energy initiatives, and promoting uniform global standards, we can accelerate the decarbonisation of the steel industry. Encouraging green procurement and fostering international collaborations also emerge as important actions. So in summary, companies and investors alike have clear actions to undertake to overcome these decarbonisation barriers. We suggest there are 5 crucial steps for the transition to green iron and steel production, including shifting investment for coal-reliant methods to those with high decarbonisation potentials, boosting renewable energy support, advocating for industry-wide emissions transparency, catalysing immediate action towards decarbonisation with short and medium-term climate commitments that are both ambitious and science-based, and ensuring a just and equitable transition that considers the well-being of communities and workers. And quickly before I finish, I'd just like to share a few of our additional resources if you haven't already seen them. On our website, we're keeping an up-to-date tracker of green steel announcements and projects that are being undertaken by all of the companies we've analysed in our report. And this week we published an investor handbook, and that provides information to guide and support engagement with companies across technology pathways, capital allocation, emissions disclosure and targets, and governance. And with that, I'd just like to thank you all very much for listening.
Thank you so much, Fiona. That was brilliant. No small feat to condense such a big report into that presentation. So thank you. And thanks also to those that are putting in questions in the chat. I really encourage everyone, jump in there. There are no silly questions. It's a huge area. So I'd like to now introduce our next speaker, Dr. Gossens, who joins us from the Australian National University. He's a senior lecturer there. He's doing incredible work on modelling coal and iron ore market flows and trades, and has a special focus also on energy policy in China, which is very relevant to this topic. So thank you so much for joining.
Yes, thanks. And I'll just start by sharing some slides. So as indicated, a few slides on decarbonization in the Asia Pacific, or decarbonization of steelmaking in the Asia Pacific, with a specific focus on China, really. The reason for that focus is obvious if you know the global steel market, but for just to drive home the point, I think this graph is always useful. The reason why we focus on China is because China produces quite a bit more steel than the entire rest of the world put together, and it does so in a fairly carbon-intensive way to add. So it's really where much of the battle for decarbonization will play out, is what we think. And then just to understand, I was asked to explain a little bit what is already going on in terms of policy making in China for decarbonization of the steel sector. And I think that can be really summarized in the following way. The way that they're going to do that is by using less steel, by recycling more scrap, and by switching to green steel making. And it's also in that order. So using less steel is the first most important leg of it. And switching to green steel right now seems to be the last option. Just to give you an idea, the overall, so total steel consumption, this is difficult to predict, of course, 30 years into the future. It'll depend a lot on things like the macroeconomic policy, how much stimulus is going into building infrastructure, etc. The housing market in China, of course, is a big question mark right now. On the other hand, there does seem to be a shift towards much more steel consumption in manufacturing, including automotive. Still, if we compare different scenarios, everyone still sort of agrees that just about right now would be the moment where China has a peak output in steel, and it would come down over the future. Basically, the ambition in decarbonization policy might make that a little bit more. If we look at that history as well, I mean, so it's been a very rapid rise in output of steel in China for the past 20 years. It's already starting to plateau, but we don't really see any sort of policies that say this is a long-term target for reduction in total steel consumption. There have been annual targets where the annual target was no more than last year for both 2021 and 2022. We saw a small dip as well, but that has been let go, those targets right now, probably because it's basically economic activity being considered above emissions policy at the moment. A second important part of China's policy is a production capacity reduction policy. So if you want to build a new steel plant, you will have to close existing capacity. Right now, that number is either 1.25 or 1.5 in areas key air pollution control. So that will be the regions around Beijing and Shanghai, Guangdong, high population density areas, basically. That rule is relaxed if you want to open a electric arc furnace, which is good for scrap recycling, but new hydrogen-based projects still have to comply with that rule. So you cannot expand without closing, even if you switch to green steelmaking. The other important thing is the, and I'll actually go to this, is the increased use of scrap. 2 years ago, roughly 20% of crude steel output would have been based on scrap-based production. By 2025, that target is to be about 30 to 35%. That's a very rapid increase. I'm not sure that that is feasible, but at least the direction is clear. This will be a very important component of decarbonizing of steelmaking. One question in that is, what is that going to cost? Because basically, we do not really know very well what the cost curve for scrap looks like, especially the right-hand side here. it's not very clear how that sort of intersects with alternative options for decarbonisation, such as hydrogen-based steelmaking, where exactly the balance lies and what the most cost-efficient way is for those additional tons of steel production is not clear at the moment. In terms of policy for demand creation, we can be simple, it's pretty much absent. The Chinese have a economy-wide decarbonisation target to peak emissions by 2030 and net zero by 2060. Originally, the steel sector was identified as a priority sector and told to have a peak emissions by 2025. That would not have been terribly ambitious. That would have really been the status quo because of the fall in steel output and the rise in scrap recycling. But right now, that ambition even has been let go. The steel sector is expected to dig up to peak emissions by 2030, which is a very soft target, really. And so far, there is not a single policy in China that mentions green steel in terms of a production or demand target. And in terms of hydrogen steelmaking policy, what is happening? We see that there are two sort of full-scale projects, so that'd be hydrogen-based DRI making, although it is really hydrogen-enriched natural gas that they use. Scaling up the consumption of hydrogen will depend on future production of green hydrogen, is what is always said. And surprisingly, in China, hydrogen policy is still very much a transport policy. So all these plans talk about using that hydrogen in vehicles, even in and this is the city of Tangshan in Hebei, which is really the key steelmaking area in China. It has a 5-year hydrogen policy, and even in that policy, it is explained that yes, we'll build a few basically hydrogen-ready DRI plants, but whether we'll actually use hydrogen depends on the development of the production of hydrogen, which will have to see its demand come from transport. So they sort of plan to piggyback on the transport sector for the hydrogen use in steelmaking. The message here is that there's still very much a big gap in how strongly China is pushing for domestic green steelmaking, at least. There is, however, also a different way. So the reorganization of global value chains for green steel. This is very much an Australia-China chain, but this could be other countries in terms of demand and supply. Right now, Australia produces a lot of iron ore and sends that to countries such as China for iron and steel production. But we also have really very good renewable resources, and that means that we could onshore more of the production and instead send green iron or steel to countries such as China, utilizing basically the very good iron ore, co-located iron ore and renewables resources that we have. I think what's important is also looking at the rest of the region, is the sort of steelmaking capacity. Fiona already mentioned it. Countries like Japan and Korea especially, they have aging steel infrastructure, will need to realign their blast furnaces. And so these countries might be interested in having some of that earlier production steps offshored. Maybe they would even be keen to just import green steel from countries like Australia. In India, steel production is still very much ramping up, and that will largely be based on domestic production. But it'll be ramping up so very quickly that they might be interested to also start to import green iron or steel, is our going assumption. Whereas in China, we really see the big difficulty. Production capacity is basically, or there's overcapacity in production capacity already, and it's still very strongly blast furnace oriented, even with recent additions. So that is a concern, because we expect that they will want to be using that capacity. Then again, if we think about what the benefits of offshoring some of the steps would be to China, is that again, the blast furnace or the iron making step is really where all the emissions are. whereas the labor intensity of the iron and steel making is really in the steel making, and downstream here means making or turning crude steel into steel products. So in that sense, it seems somewhat likely that the Chinese might be willing to sort of offshore the dirty, less economically interesting steps, is what we would hope. This is also somewhat reflected in a policy document for the steel sector, where they say let's encourage the imports of semi-manufactured products. So already hinting at this idea that they might be happy to do so. Other options, if we don't think about a policy creation for or a policy push for demand creation, the message that we always have is let's also look at where basically a green premium could come from consumers. And I think we should really analyze this in terms of in what sectors or what products is it technically feasible to use green steel? What is the cost differential of using conventional versus green steel in those products, and how are customers for those application willing to pay extra? Probably we feel in automotive, folks would be more willing. If you're going to buy an electric vehicle, why not buy one that has uses green steel or green aluminum? In other industries, we're not so sure. We think that this is something that needs to be researched. One of the mechanisms that also needs to be researched, we feel, is that of guaranteed offtake contracts. The report earlier presented also lists these, so ensuring this sort of demand for steel plants so that they have a guaranteed market from their consumers, and also for the steel plants demanding green iron or greener ores from their producers. And lastly, a big question that I think plays between these countries and where both corporate and government may intervene is in a reorganization of the value chain. If we're going to have a lot of green iron or steel capacity in Australia or other iron ore producing countries, we need to draw in Chinese, Japanese, Korean investment, and we have to figure out whether that is interesting for both sides. That is a big discussion to have at the national level, we think. Lastly, this is just a summary, really. So for encouraging the transition to green steel in the Asia Pacific, key issues are really that we still need to have a push towards Chinese government policy actually demanding green steel. We need to encourage reorganization of international value chain, and we need to identify nursing markets. Where is it the easiest to sell green steel? I'll actually just skip this slide on the basis of time, but I just wanted to note that we are modeling this sort of reorganization of value chains at the ANU, where we look at both the costs of energy and steel production or iron production processes, and where we also look at the iron ore chemistry, so the suitability of ores that we mine in Australia or Chile, China, India, etc., and how suitable they are for different conventional versus green steel making processes. Don't have results on that just yet, but that will be coming out of the ANU over the next months and years. So I'll leave it at that.
Thank you so much, Dr. That was excellent, and I think answered some of the questions coming through there in the chat. But if you're able to look at that Q&A box while we hear from Jasmine, as I will jump back to you for some of those more specific questions. Over to you, Jasmine.
Hi everyone, my name is Jasmine. I'm an analyst in ACCR's Steel and Diversified Mining team. And today I'm going to be taking you through the results of a global survey that we conducted to gain insights on investor sentiment surrounding steel decarbonisation. So we surveyed a total of 500 investors, all of whom held investments in at least one part of the steel value chain, and all of which managed assets of significant value. So as you can see in the charts, the investors we surveyed were from all over the globe and worked in a range of financial services. So while it was tough to narrow it down to just 4, here are the main findings of the survey. So starting with the definition of green steel. While there is currently no widely accepted definition, there was a consensus among investors that green steel is made without fossil fuels. Almost all investors expect the risk profile of metallurgical coal to increase by 2040 or earlier. I'll cover this in more detail shortly. However, it is clear that most investors do not see met coal as continuing to be necessary in the steelmaking process, and many are already receiving clear signals to divest. Risks have been identified, yet there has not been a lot of preventative action, with almost half of investors acknowledging that their institutions are yet to review their portfolios for climate-related risks, which includes stranded asset risk. And finally, many investors see policy incentives as key to accelerating the transition to fossil-free steel, and many are also active in this space. So I've broken up the more detailed findings into 3 sections, the first of which focuses on green steel. So as I mentioned before, while there is currently no globally accepted green steel definition, the vast majority of investors agreed that green steel is produced with renewables and green hydrogen as opposed to fossil fuels. We also found out what investors do not see as green steel. So more than 2/3 of investors believe green steel is not simply steel produced with fossil fuels and then abated with technologies or offsets. Additionally, 71% of investors also disagreed that green steel could be produced with gas-derived hydrogen, which you can see on the right here. So we also asked investors what they believed to be the 2 greatest challenges and 2 greatest opportunities for green steel. So starting with challenges, technology maturity and capital expenditure were seen as the greatest challenges with the highest response rates. So clearly there are questions around whether technology is mature enough and cheap enough among investors. As for opportunities, investors see the biggest opportunities to improve their fund's reputation and align portfolios with ESG benchmarks. So as Fiona explained before, iron has a coal problem. So this section focuses on how investors perceive metallurgical coal use and as an asset. So as you can see on the left, almost 2/3 of investors do not believe the steel industry will rely on met coal until 2050 or beyond. Also, half of investors are already receiving signals from their customers and shareholders, signaling their wish to divest from met coal assets. So we just saw that many investors do not think met coal will be relied upon long term. So now let's look at that time frame of that risk in a little bit more detail. So we asked investors when they expected the risk of met coal mining and use to increase, and you can see the cumulative percentage of their responses here on the left. From this, there was an overwhelming response or consensus that the risk profile of met coal will increase in the short to medium term, with all respondents selecting a timeframe earlier than 2045. Many investors selected even earlier timeframes, and so based on this cumulative trend line, half of investors expect the risk of met coal assets to increase by roughly 2032. So we've looked at the timeframe. Now we can look at what are the perceived risks associated with met coal. So we asked investors to select what they saw as the 2 greatest risks, and we found that the highest response rates were surrounding reputational risk and also the risk of stranded assets. And just to add, reputational risk is clearly seen as important, which you can see on the right here, with close to half of the respondents actually indicating that this risk outweighs the financial benefits. And as for stranded asset risk, 41% of investors saw this as significant, yet this risk does not appear to have been mitigated in many circumstances. So we found that 46% of investors acknowledged their institutions are yet to review their portfolios for climate-related risks, and this includes stranded asset risk. Let's look forward to what opportunities investors see for the steel industry and also what they're doing about it. So what factors do investors expect to impact the steel industry in each region? What we found here was that investors expect numerous factors to impact each steel industry. However, there are some differences between the regions, as you can see here. So I'll start with the similarities. What we found here is that in all regions, the availability of renewable energy, green hydrogen, and capital are expected to have significant impacts on the industry and accelerate the transition to green steel. As for the differences, you can see that the EU cross-border mechanism, or CBAM, is expected to impact the European steel industry a lot more than North America or Asia Pacific. On the flip side, in Asia Pacific and North America, having the most capital is by far the most important factor in these regions. So 55% of investors agreed that the demand for green steel is already growing rapidly, as you can see here on the left. So what actions are investors taking in light of all this? We found that many investors are actually taking multiple approaches in their engagements. So on the left, you can see that more than half of investors engage with companies, and they do that by voting in favor of resolutions, which ask for increased ambition or transparency in their decarbonisation efforts. In addition to that, half of investors are lobbying their governments for more incentives that will attract further development of renewables. The availability of renewables is definitely seen as an important factor in this transition, but where that availability is limited or the opportunity to expand that availability, many investors see importing green iron as a solution. Okay, so that's all I have for today. Before I wrap up, I just want to quickly answer the question, where to from here? So with these results, we have a report in the works, which will cover these survey results in a little bit more detail, as well as touch on the implications of these findings. So yeah, watch this space.
Thanks so much,
Thanks.
Jasmine. That's great. All right, let's jump into some of those questions. And Hard, I'm going to go to you first. We've got a few questions here from Sulin. Thank you, Sulin. Particularly around Chinese steelmakers. Now, you touched on demand in your presentation a little bit, but whether you see that change, if there's a current lack of demand in green steel and where that might change, and also around offshoring and how feasible it is. Again, if you want to elaborate on any of the points from your presentation.
Yeah, sure. So the hesitance in the Chinese steel industry is definitely there. It is that lack of a clear demand for this product, both from basically automakers or the industry, but also that policy signal that is just lacking. And it's not just the demand target, but also really the overall sort of policy settings right now do not have very clear signals that the government would be making haste with green steel making. It's about emissions reduction, and if that can be achieved with less steel and more scrap recycling, then that is fine for now. It's also true that steel making is very unprofitable in China. A lot of overcapacity. The assessments that I've seen are that there's about 2% profit for the industry as a whole. They do not exactly have a whole lot of money to invest in this process, so that all of that is limiting their actions on this. In terms of offshoring these value chains, I see that you are concerned especially about how likely that would be in Australia. I can say that the industry right now is entirely focused on this. We work in the HILT CRC, so Cooperative Research Center, where industry and universities work together, and there's a good number of the iron ore miners are involved in this, and this is the discussion that is playing out. It's not so much a matter of will this happen, but more of a matter of how is this going to happen. The ambition is definitely there, I would say.
Thank you. That's helpful. And staying with you for a moment, there's a few other questions here. One in terms of that policy effect and the CBAM and companies across Asia. Do you see that there's a connection there, or are there ways that investors can get involved in terms of asking questions of companies in relation to policy improvements?
Yeah, so the CBAM, we do see that as quite important. I mean, it has to be noted that there's not an enormous amount of steel being traded, of course. Trade is mostly in terms of either iron ore or otherwise finished products, and those would not be covered by the CBAM, as I understand. However, there is an idea in China that the imposition of this CBAM, that they basically need to follow suit, and so at least they do seem to be accelerating their push for emissions monitoring. So they have an active carbon market for the electricity market. They're planning to draw in other sectors, and the sort of view is that the imposition of the CBAM has accelerated the process of formally bringing other sectors into that carbon market, that they're preparing for that. What investors might be, or what role investors might be having in this, I find that is difficult to answer. I think that really comes down to spurring the, in lack of government signals, it really comes down to encouraging the corporate green premium. So trying to figure out whether automakers might be interested in labeling their cars as being very green because they're using green steels, etc. That might create more of a green premium, or that is perhaps a more feasible route to creating those nursing markets than convincing the Chinese government to step up the action.
Thank you, that's helpful. And just a final question there that's come through in terms of the relative operating costs and total costs comparing traditional steelmaking methods and green steel. I can imagine that this is changing rapidly as technology improves, but do you have a view on some of those cost comparisons and a carbon price that might be needed or useful in terms of making that competitive?
Yeah, I'm going to say that those are excellent questions. My research and my colleagues' research really very much focus on exactly this sort of stuff. And I mean, this is a matter of how is the future going to develop. So we know that currently green steel is not competitive directly, that much is clear. And then the question is really how ambitious are government policies, and how strict are carbon pricing policies going to be. I don't have a number exactly, but I know that it's not going to be in the order of $500 a ton. It's definitely going to be in that sort of entirely feasible range of $0 to $100 a ton of a carbon price. I can't really specify it much more clear than that. That is the subject of a lot of research, both at the ANU and elsewhere still.
Great to know, thank you. And I'm sure people will be looking you up after this, Jorrit, to track that research and to get those updates that you mentioned coming in the coming months and years. I might jump to you, Fiona, for a couple of questions there. One was around getting more colour around the projects that constitute different investment projects and how you classify them, and then also a comment on the feasibility or the state of development on technologies such as CCUS, electric arc furnaces, green hydrogen at scale.
Since we've got only 5 minutes, I'll touch on the second question first because it's a bit bigger. So CCS, Carbon Tracker recently reviewed CCS projects globally, and I'm reminded of a quote. It said that our review of the CCS projects currently in operation have found a consistent trend of overpromising and under-delivering. There's other analysis that's come out of Austria that said that the only CCS capable project that is on a steel mill currently is processing an estimated 13.6% of carbon emissions. So CCS, has been in the works for decades and is not producing material reductions in emissions. Moving to electric arc furnaces, this technology is already in use. So what is needing to happen is to ensuring that there's enough renewable energy capacity to ensure that this process is completely green. SSAB, I think it was last year, produced green steel using this method. So scrap steel in an electric arc furnace to produce steel. I think it was for Volvo, but I need to double check that. And then on green hydrogen, it's a key material in many regions around the world. It will be a key material, I should say. Billions has been gone into making this technology scalable and cheap. So while it hasn't been made to make green steel at scale, it has been used in pilot tests. And the green steel ventures that we mentioned in the webinar and in our report are also looking to use green hydrogen to make green steel within the next 2 years at commercial scales. So we're really looking forward to them realizing this technology very shortly. And then Naomi, can you remind me of the second question? Sorry.
In regards to the different classifications of technologies and any examples that you can give on those sorts of projects that are being invested in.
Yeah, absolutely. I mean, I very much welcome you to refer to the slides. But we had 3 technology categories. They were green potential, low carbon potential, and limited potential. Some examples of green potential were renewable powered electric arc furnaces, green hydrogen-based iron making, electrolysis, which is an electricity-based iron making process. There are a few companies that are looking at that. Boston Metals out of America is one of them. ArcelorMittal is also looking at this. Low carbon potential, so this is where carbon or fossil fuels may still be used in this process, but have reduced emissions significantly from blast furnaces. So this is, gas-based iron making, biomass use as well. And then we had limited potential. So these are technology solutions that offer really minimal decarbonisation capacities on their own. So this is mass balance, CCS, offsetting, and blast furnace optimization routes.
Brilliant, thank you. And I might also do a plug to the steel tracker that we've got going on, because you can actually jump in there and see exactly what projects are taking place right now between different companies globally. So for anyone that's online, if you go to the ACCR website, if you click on the top bar on companies and then click the first tile there, the steel sector, you can jump in and have a look. It's being updated. It was updated just this week with a recent announcement. So that's got heaps of information about very specific projects and whether or not they've disclosed how much they're investing in those projects, for example. With 1 minute left, and I can see that there's typing answers going on, so I'm going to leave it open and just talk to some of the opportunities for investors to get involved. And maybe, Fiona, I'll jump back to you one last time in terms of how can investors be engaging? And maybe if you could touch on the handbook that we also released this week.
Yes, absolutely. So we released the investor handbook. It's guidance for how investors, all stakeholders really should be engaging with these companies. In that report, we've got some tables that have a section on company responses, some evidence to back up your response to that company's response, and then some additional questions to take the engagement further. And so we look at the technology options, we look at governance, we look at setting targets and climate disclosures, and so really help investors to take that engagement further. In terms of what collaborative initiatives investors can be undertaking, obviously you could work with us, ACCR, and engaging with these steelmakers and these companies. There are other working groups that we know of at IIGCC, IDCC, AIGCC. All of those different collaborations are excellent, and working with steel companies as well.
Brilliant. Okay, we are well and truly at time. Thank you everyone for joining us today. Thank you again to our speakers, so informative. We will make sure that we send out a copy of the presentation and the slides to everyone that's joined. So thank you again and have a great day.